The 90-day pause in the implementation of the US administration's trade tariffs comes to an end later this week. This pause was put in place after the market turmoil caused by the announcements made in President Trump's Liberation Day speech in early April. And whilst a small number of trade negotiations have resulted in some deals being struck during this hiatus, such as that of Vietnam just last week, other economies have seen less announced progress, and many discussions are thought to still be ongoing. Markets are still therefore having to deal with a highly changeable environment associated with global trade, and there is no doubt that several emerging market classified economies are some of the most sensitive to these step changes in trade terms with the US. However, implied returns from equity markets in many emerging markets appear attractive in our opinion, particularly on a relative basis. And as we've referenced and evidenced in prior episodes with other EM managers, the growing importance of trade between and within EM regions, such as that within the Asian economic bloc, remains a highly important trend for the next decade in our view. Signs of increased solidarity between emerging economies has also been evidenced recently and since the America First policy has been rolled out by the Republican administration. Examples include China's use of the yuan in overseas transactions further increasing, and also India striking oil deals with the Middle East in rupees, not US dollars. In today's episode, we discuss the EM investment outlook with the highly experienced James Donald, Head of Emerging Markets at Lazard. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. James Donald is a hugely experienced emerging market investor. Having started his career in finance in 1984, he joined Lazard in 1996 and has been instrumental in developing the asset manager's emerging markets division. James is the portfolio manager of the Lazard Emerging Markets Fund, which is a strategy run with an investment philosophy which aims to assess the trade-off between financial productivity and relative valuation. The implementation of the investment process leads to a portfolio of companies which very consistently exhibits higher profitability metrics but lower valuation multiples when compared to the broader index. And we explore more about the approach used in our discussion with James. We hope you enjoy this episode, and as always, please get in touch via the email address investorinsights@killik.com for further information on any of the topics discussed. James, thank you so much for joining us in person for this interview recording. How are you doing today?
Very well, thank you. The sun is shining. It's a beautiful day.
Yeah, it's a lovely hot day in London today. James, we've got this standard first question we ask, and what it attempts to do is get to know you a little bit better, really, and kind of how you go about your work. And we ask the speakers for an anecdote from a recent trip that they've been on, or even just an article or book that they've been reading. Is there anything that you could share just to give us a bit of an insight into kind of how you go about things?
I don't want to give you too many, but I'm going to give you a few.
Oh, great.
I was in Asia for a month at the beginning of the year. It was actually a time when stock prices were running up quite strongly, and it was fascinating to me that a lot of people that I met were far more bullish at the end of that stock price run period than at the beginning, but it was a very interesting time to be there. I was also recently in Morocco, which is a relatively small market, but one we've been invested in twice in the last 35 years. And fascinating to see that country with its huge coastline developing as fast as it is developing. So, again, a market I'd love to see greater liquidity in and opportunities, but a lot of things happening, particularly, by the way, as a coastal transshipment center in the world. The third thing I would just mention is I was in a meeting with a company from South Korea, which we've been invested in for over 20 years now. And they gave me 5 quotes from the recently elected president of South Korea, which were mind-blowing in many ways. He was basically calling for any repurchases of shares by South Korean companies to be canceled instead of stored and then sent into the market again, which is very different from anything we've just about seen from South Korean companies. He was saying that any company with a low valuation should possibly be liquidated, which is also a very different situation than what we've seen, and also indicating potential tax break opportunities for companies with payout ratios in terms of dividends below 35%. So those could be extraordinarily positive as catalysts for the South Korean market.
Yeah, no, fascinating. Yeah, it's always good to get an emerging market manager in because they're always very well travelled and you get lots of anecdotes from around the world. So thank you for that. James, I wanted just to frame the discussion or the rest of the discussion. I wondered if I could ask you just to kind of summarise the investment strategy that you use, because it comes up with a portfolio which does look quite different to many others, quite different to the index, that kind of quality and valuation approach. Could I ask you just to kind of summarize how you go about things with the strategy?
Well, this is very much a quality value portfolio. We are aiming to invest only in companies we think are mispriced by the market because they have a level of profitability which we define as return on equity, which is relatively high and stable over time. And as part of our process, we essentially go through all the reasons we could possibly imagine for the valuations being so low. And at the end, we should have a reasonable understanding if there is a good reason why the company is relatively lowly valued. So we've always had high profitability and we've always had relatively low valuations. So it's really mispriced securities, and the market does not always value things the way we value things. And so it gives us, we think, very interesting opportunities to have a portfolio very differently positioned than the market.
Yeah, sure. No, I think that'll become clear when we go through some of the other questions in this interview. You've just explained a kind of a pretty bottom-up approach to analysis, and I'm gonna ask you a macro question to kick off. So apologies about that, but we can't kind of ignore the kind of big news story of this year being kind of US trade policy changes and that kind of Liberation Day speech and the aftermath of that. I wondered if I could ask you just kind of to talk us through how you approached the volatility that we experienced after that and the kind of longer term implications that you see from that change in policy.
Well, the Liberation Day speech and the tariffs are a huge change for the world. I think most people in business do not see them as a favorable change, but all the same, we're in that situation. And we have to factor them into what happens for companies we consider investing in. And I think the only 2 conclusions we can come out with at this stage are that tariffs are going to rise around the world, hopefully not by too much to snuff out growth around the world, but they're going to rise, and that is going to pull growth down. And we're just going to have to see how we come out with this. I think President Trump feels that he was put into power by a lot of people who want to see tariffs increase. They may not have all been doing their historical reading, But I think the result is that we're going to see higher tariffs. And net, that's not going to be good for most entities around the world, including in emerging markets. But I think it's probably going to be more of a challenge for the U.S. economy than it is going to be for most other economies. And whereas we were expecting the U.S. dollar to start to depreciate fairly slowly, we think there's a higher likelihood it's going to depreciate over much of the next decade. That probably means that investors are going to be less eager to invest in the U.S., and particularly a lot of the leading stocks in the U.S., including the Magnificent Seven, and they're going to start looking at other areas of the world, including in emerging markets. We've already seen this with quite a few investors. We think it's early in this trend, and it would not take a great deal of money to start to increase interest in the emerging markets. So we do have to see what it does. We've had to bring down some of our price targets. I think as tariffs agreements get put in place, it will do that. But on a overall net basis, I think it probably will have the effect of increasing interest in emerging markets and resulting in better emerging market performance.
Yeah, no, thank you for that. Certainly some very significant trends underway at the moment, so it'd be interesting to see how that plays out. No, but thank you. We're just looking at the kind of emerging market investment universe, you kind of, it's often grouped together as one, but there's a huge disparity of different economies, different markets out there, and you just see that from the performance of single countries within emerging markets kind of over any period, really. I wondered if I could ask you to talk us through how, when you implement your investment strategy, whether there's any particular themes to which markets you're allocated to at the moment, and which you're perhaps more lightly weighted to.
Well, we have tended not to have a great deal in China for a long period of time. In the last 2 years, China has essentially been on sale, and that includes quality companies in China. And historically, that has not been the case. So we have a lot of companies there, in particular in areas like healthcare, consumer, and internet that used to be, very, very expensive and impossible for us to own. And so that's been very interesting as they've come down dramatically. India is a very difficult market for us at this stage. It's a very exciting economy. It's growing very quickly. There is a lot of high profitability in the Indian corporate world, but the valuations are extremely high. And whereas I don't think we're going to see a huge downward movement in India, again, the valuations are just too high for us at this stage. So we have to watch it carefully and take action when we see opportunities there. We see great opportunities in parts of Latin America today with very low valuations, and basically global and local investors being disenchanted with those markets because of political issues and because of high interest rates in Brazil, for instance. A lot of investors are not interested in investing there. But for us, so a lot of companies are still doing very good business there and are suffering with very, very low valuations for their companies. And we think that will only be in place so long.
I wonder if we could delve into the China allocation a bit deeper, if I may. I mean, it is, as you mentioned, a kind of market which optically does look very cheap at the moment, particularly relative to other areas and developed markets, certainly. But it's clearly a country which is still working through quite a lot of economic challenges of its own. I wondered if you could kind of talk us through how the opportunity set looks under your lens of looking for quality businesses, but perhaps mispriced. Kind of what does that look like?
Well, I'm not expecting the Chinese economy to grow at the same pace it has historically. I think it's going to be more like a 3% economic growth scenario for the next decade. It's suffering from really two areas. The property markets have been under a lot of pressure. They were extremely strong for 30 years. And then, as often happens when you have a very, very good period, I think they're going through indigestion, to say the least. And I think we're starting to see the beginnings of an improving trend, but it's still going to take quite a lot of time for it to get better. So I don't expect great opportunities there, and I think that's going to hold down the economic situation. The other is really foreign direct investment, which historically has been very high. I think the geopolitical situation is what has changed, and the result of that is that companies are building capacity in other places that they think are second options or third options, just in case something really negative happens geopolitically between the West and China, or between China and other parts of the world. And so globalization, in a sense, has taken quite a big back step, which I don't think will really change for a while. So we're seeing, because of that, less disinflation, less deflation, more inflation at this stage, which is not necessarily that bad for emerging markets. I think on a relative basis, it's actually quite good for emerging markets, because emerging markets produces a lot of goods, including commodity products, and those things are likely to go up in price, even with a situation where economic growth around the world has come back. So it's a changing situation. I think it's giving us opportunities in some of the markets that are still viewed quite negatively, like Latin America, for instance. I think in China we're seeing some very interesting changes. Um, this year it's been more difficult for us in China because, quite frankly, stock prices have gone up a great deal, and in areas where we've had some reasonably large investments. So we have been trimming back those. But there's still a lot of places in the emerging markets that we're able to look and invest.
You and a couple of colleagues at Lazard recently gave a like an update call. Is it the colleagues from various places around the investment side of things? And one of the takeaways that I got from that discussion was this view that you're seeing improving profitability ratios in emerging markets, and that's kind of been perhaps one of the factors that's at least partially explains the reason why developed markets have outperformed over kind of the recent period. But you're seeing kind of signs of, historically, this might probably not be the phrase that you use, but historically lazy balance sheets are kind of starting to improve. I wondered if you could kind of give us some examples of where you're seeing that happening and kind of the scale of that change.
When you look at emerging markets on a price to earnings valuation basis, they're trading at something close to a 40% discount to the US equity market, which is a pretty big discount. They're enjoying faster earnings per share growth, but their profitability is lower than the US market. And about 70% of emerging markets is in Asia. There's a certain level of caution in Asia, coupled with, I think, business consciousness by founders of companies, where they feel they don't want to have any net leverage. When you have reasonably low interest rates, debt acts as a very, very low cost of capital. And so it's our view that a certain amount of leverage, not a high amount, but a certain amount of leverage is a good thing for companies that have profits and cash flow. It essentially gives you an advantage in your cost of capital. And I think across much of Asia, they haven't done this. It's also true that Asian companies seem to have a real growth mentality in their minds. And when you're growing, you often have to spend money aggressively. So that's why a great deal of companies in China, South Korea, Taiwan, and in many other parts of Asia tend to have net cash balance sheets, which is how I would describe lazy balance sheets. And if companies have good cash flow and free cash flow, there's no real reason why these companies need to have net cash on the balance sheet. It just makes their returns lower on the whole, unless interest rates are very high. So we're in a very interesting time where I think people are starting to understand that. Japan has begun to understand that in the last 10 years. And when I was at a Japanese conference in March in Tokyo, and in every Japanese company presentation, they were talking about returns. So that has changed. And I think some Asian country corporates are starting to follow in that direction. In particular, we're starting to see that in South Korea. And it's really very early indeed in that process. The South Koreans have particular issues, not unlike the Japanese. They've got to worry about. They've got a fast-changing demographic situation where the fertility ratio is coming down extremely fast, and the South Korean population is living to a very old age. And the government, I think, is extremely concerned that they're not going to be able to have enough money in their pension system if something isn't done in terms of putting more money into the system, asking people to work longer, or lastly, getting higher returns out of companies. And that higher return point is the one I think they're prioritizing at this stage.
Yeah, we've spoken about the governance reform and the corporate reform going on in Japan in the prior episodes. So it would be very significant if that spreads to places like Korea and elsewhere in Asia for sure. And James, I wonder if I could squeeze in two last questions, if I may. One of them was about managing risk within a kind of value-orientated strategy, emerging market strategy. And clearly you've got the valuation kind of margin for safety, but I wondered if you could talk through a couple of other areas that you look at to manage risk within the portfolio.
Well, we have maximums and minimums by country and by sector. Sometimes you have a sector or a country that is extremely risky, and you don't want to have anything there. So our bottom, our maximum minimums, if you like, are zero. We have at zero even in quite big countries sometimes. But on the whole, we look for diversification. It's very, very important for us as a method of protection. And we have maximums for countries and for sectors. The largest maximum we have is China is the biggest market, about 40%. But as I've said earlier, we've historically not tended to have very much in China. And today we have below 30% in China. And we think the opportunities are fairly good at this stage. So those are certainly areas of great interest. For almost 25 years, we've implemented ESG in our process. So I know it's been a huge trend in the last 7 or so years, but 25 years ago, I noticed that we in emerging markets were subjected to pretty high ESG risk because we're less protected, and we almost always have controlling shareholders in emerging market companies. And so our analysts are used to asking questions about ESG. They're used to thinking about alignment with management and owners of ESG of companies according to ESG structures. And we've been a part of the ESG movement through that period of time. And we don't necessarily think it's less important than our financial analysis. We think both are extremely important, and ESG is probably the single largest risk that we see in emerging markets.
Yeah, 100%. James, to finish up, we have this kind of standard final question, kind of standard opener and a standard final question. We asked the speaker for an area of the market, a region or sector that they had particularly high conviction in at the moment. You've kind of talked through quite a number of areas of the world already, but I wonder if you were to kind of pick out one particular area of the portfolio that you have particularly high conviction in, what would that be?
Well, it's a danger because I'll probably stick my neck out and we'll have all sorts of difficulties in it. I do think Brazil right now is very, very interesting. An awful lot of people hate it, including domestic investors. Very high interest rates. President Lula is in his 80s. He wants to leave a legacy for the people who have voted him into power. So he's essentially fighting with other political groups. And so it's not the sort of place that brings back many favorite views, but I think it's pretty impressive to see the way Brazilian corporations are dealing with 15% interest rates. Some of them are still getting very, very strong returns in that market. And let's face it, they've had to deal with much greater volatility in their economies and in a lot of the variables they deal with over time. And so in many ways, they're excellent managers. So right now you can buy quite a lot of stocks in Brazil at quite inexpensive levels. And on that basis, I think it could be a very good market in the next year or so.
Yeah, interesting. James, thank you so much for spending some time for this. I really appreciate it.
Thank you.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.